Well, welcome everyone to this session. Just to verify that everybody is in the room they want to, this is the FX session. I know we switched room just last minute, so I repeat, this is the FX session. So this session is meant to discuss the new cross-border settlement initiative that the Mojalu Foundation is launching. Perhaps like just a quick reminder about the format of this session. This is a breakout session, so it is meant to be slightly less formal, and we are expecting as well like a contribution from the audience. So because we have a few seats around the table, perhaps for people who are not around the table, could you please move forward and find a seat around the table? That would be nice so that you can contribute more easily. Would you mind to come closer, perhaps? Yeah. Before we start, first, so let me introduce myself. I'm Julie. I work for the Mojalu Foundation. And I'd like to introduce a new initiative that the foundation is launching before giving the floor to our highly recognized expert. So in terms of the introduction, the initiative that we are launching. So one of the key principles of the level 1 project is that the cost of processing an instant payment should be minimal, just a few pennies. We know that when Mojaloop is deployed, we are able to achieve this objective. However, for cross-border payment, especially when there are illiquid currency involved, we continue to face significant challenges related to the cost of foreign exchange and settlement. So to address these challenges, the Mojalu Foundation, in collaboration with selected partners, is launching this new initiative focused on identifying innovative solutions to reduce FX and settlement costs, with the ultimate goal of achieving a total processing cost of less than $1 per transaction. What we are doing is we are focusing on a single corridor to start, which is payments involving the Malawan Kwacha and the Zambia Kwacha. And then overall, we're also going to look at other key corridors of the COMESA region. And ultimately, our broader objective is to develop adaptable frameworks that can be applied to other regions facing similar challenges with illiquid currency. This initiative will be driven by 4 strategic work streams, each exploring different approaches to reduce FX and settlement cost of cross-border payments. So the first one is around utilizing existing stablecoin. So the purpose of this work stream will be to see to assess how stablecoins can simplify and lower the cost of currency conversion and settlement. So work stream 1, utilizing existing stablecoins. Please remember this because you will be asked a question about it. Second work stream is actually looking at advancing the work for some of the BIS projects, like exploring the operationalization of Project Dembar and Project Mbridge, which focus on decentralized exchanges using central bank digital currency. So again, work stream 2, advancing BIS projects. And then the third work stream is about exploring the feasibility of creating our own stable coin that will be backed by a basket of African fiat currencies to improve FX efficiency. So I repeat, the third work stream is exploring the feasibility of creating a stable coin. And the last work stream, which is the fourth one, it's actually looking at enhancing existing FX and settlement mechanisms. So we are looking at identify ways, for example, to broaden the access to correspondent banking networks. And we're also exploring instruments such as central securities depositories that typically reduce liquidity costs in developing countries. So today, joining me to discuss this important topic around how do we reduce the cost of FX and settlement, we have Jedida. from the COMESA clearing house, the hub operator for the first flow that we're considering. So again, money movement between Malawi and Zambia. We have Mike from SWIFT, the world's largest financial messaging network used by correspondent banks, financial market infrastructure, including the Treasury, MICLS, and non-banks and FIs and corporates. And we have Barry from Sendfree, a non-profit think tank supporting financial inclusion and sector development across Africa. So now that I've sort of already revealed your addiction for liquidity management, could you please introduce yourself a bit more in detail?
There we go. Overcome the technical challenges. Hi, everyone. I'm Mike Truter. I'm Regional Head of Industry Engagement for SWIFT in EMEA. And I spent the first 7 years of my life working on a treasury trading floor. So that's my little bit of background to kind of become acquainted with this topic.
My name is Jedida. I'm with the COMESA Clearing House. I head the operations there. And I've been there for several years now, doing cross-border payments and indirect experience of the challenges that we have with FX. Happy to be here. Thanks.
Good afternoon. My name is Barry Cooper. I'm a technical director at Sendfree, the Center for Financial Regulation. I started out as a lawyer, and I've probably been a banker probably about 30 years in processing, and constantly involved in these kinds of issues across the continent. Thanks.
Thank you, everyone, for introducing yourself. So before we discuss more about the solution, I'd like to start with assessing the size of the problem. So effectively, when we looked at the figures in the FSB's latest report, we can see that the cost of cross-border payments is a big challenge. As highlighted in the FSB latest report, Sub-Saharan Africa lags significantly on cost, with average retail cross-border payment cost exceeding 3%, which is a global target to reach by 2030 and sometimes even higher. So this high cost disproportionately burden smaller remittance and transaction that the Mojaloop Hub is looking to process, limiting financial inclusion and creating barriers for individual and small businesses to access essential financial services. So, Mike, could you share, perhaps according to your analysis and particularly SWIFT, which contribute to publishing some of this report, how much of these costs, which are exceeding the 3% benchmark, could be attributed to the inefficiencies in FX and settlement?
Okay, I'm going to try and cover that. As many of you may know, SWIFT doesn't do FX or settlement as well, but certainly it impacts on kind of what we're involved in. And I think a big portion of this to understand is that actually the FX component of a cross-border payment is typically the biggest component to contributor of cost. And the reason is really because organizations that do foreign exchange need to price their risk. And as you know, when you've got a highly liquid currency, that risk and the amount of flow and liquidity available obviously means that it's relatively easy to come across liquidity. Unfortunately, when you get to illiquid currencies, the margins need to be wider to be able to cope with the lack of liquidity and the risk that will be on those institutions to take. And then also low volumes don't help as well, because low volumes with complicated processing as well adds to the overheads that need to be covered. And so you've got these challenges which are kind of inherent in the system, unfortunately, that contribute to the FX component being rather challenging and contributing significantly actually to the cost and the overheads there. And I think the reality that comes from that, of course, is it leads to suppliers also want to avoid that challenge of risk themselves. And so they invoice or tend to invoice in hard currencies as well, which further contributes again to kind of making adding to the challenges. And I think we don't just see it for suppliers, but I think consumers as well. And it's always very interesting for me that something like 50% of all US dollar notes are kind of used outside of the US ecosystem. And even in Europe, I think the figures I saw back in February, something like 15% of all euro notes are also used outside of the European Union. People hold these things as a way to keep hard currency as well, just to kind of get around the challenges that we see in foreign exchange or trust of illiquid currencies. I could go on. Do you want me to stop there?
Thank you for your insight. I'd like to basically get the feedback from Barry on this as well. Barry, you've been looking at this problem for quite some time. I remember like the first time we met, this is one of the first things you mentioned. So perhaps like, could you share some insight about the size of this problem?
Yeah, so we've noticed that particularly with remittances and others where lower income or mass populations are involved, exchange margins and spreads are very, very opaque, and eventually they're used to hide a multitude of sins. And this is where a lot of the cost ends up. 3% is in many cases a wishful dream to get to. It's in the region of 7 to 9% and even into the 20s of percent, depending on how it's regulated. So that's been a really a guiding light for us is to how can we chip away at all these costs in and around these transactions? How can we get to a point where financial systems and payment systems are not a main role player, but mere background? We don't think of it. We just use it because it's inexpensive and it suits our needs. So that's a lot of the research that we've been done, and we've looked at how can informal institutions do this much more cost effectively and a lot more with a lot more trust. So those are some of the things we've been looking at, and particularly in building a master plan. A lot of this culminated building a master plan for the EAC regions across 8 central banks, and that was, thank goodness, was signed off 3 weeks ago between the eight central banks. So there's a lot of these things that are in motion. But yeah, I agree. It's a problem that is stuck with us probably for the last 2 decades.
So, Jedida, one question for you, right? Obviously, as Barry just mentioned, it's a problem that has been stuck with us for almost the last 2 decades. So, long-lasting challenge. How does the challenge influence the operational and business model of DRPP, which is the regional cross-border payment system that you are implementing currently across the COMESA region targeted for MSME? And yeah, like how much does it influence your overall design?
Okay, thank you, Julie. And thanks for some of the figures you've mentioned. Really shocking. We're always working on the 3%, not knowing how high this has gone. Now, the challenge of these costs is precisely why we designed the DRPP. And so I would say that these costs that have been given to us now directly speak to our model, and the fact that such high costs actually undermine financial inclusion. They undermine what Mike just said about low value transactions, which is what the people we are targeting are those that push through low value transactions. So high costs will deter them from using the system. So I would say that the strategic design of the system was built with this in mind, the high costs of cross-border transactions. So by introducing the local currency element, where we are allowing users to push through transactions in local currency, and then the settlement happens within their domestic payment systems, we are moving away from the traditional mechanisms of cross-border, corresponding to really reasonable levels. So a lot of the design, it's coming from those costs. That's the question we're here to answer today. Yeah.
Thank you for this. Okay, so obviously long-lasting challenges, the 3% is like, wishful dreams. So now that we really understand how significant this problem here, like I'd like to sort of hear the voice of and the opinion of the audience here. So at the beginning of this session, I mentioned that we are launching 4 different initiatives. Again, the first one is looking at existing stablecoin. The second one is effectively advancing BIS projects. The third one is exploring the feasibility of creating a stablecoin. And the fourth one is enhancing existing FX and settlement mechanisms. So this session is going to be a bit unique in the way we operate. So I'm going to ask you to basically vote the old-fashioned way. When I mention the workstream number, please raise your hand. And then after the audience have voted, our expert on the panel will also pick which one they think is the solution, and they will pitch for 3 minutes on this solution. And after the 3 minutes, and when we have heard their compelling arguments, we will redo the vote again to see if they manage to change our opinion or if not, and we stick with the way we think is the solution. So we're going to start the vote now. So I'm going to ask within the audience who think utilizing existing stablecoin to reduce the cost of FX and settlement is a solution. Please don't vote. Only the speakers don't vote, only the audience, because you're going to pitch in 3 minutes. Okay? Because of the lack of clarity in what it is that okay, so I'm gonna re-explain how the session is gonna work. So the Mojalu Foundation is launching a new initiative, trying to figure out how we can reduce the cost of FX and settlement. To do that, we are looking at 4 different instruments or initiatives. The first one is we are looking to see if we use stablecoins instead of using basically the current correspondent banking network that we're planning to use for settlement, would that improve and reduce the cost of FX and settlement? Or the second instrument we are looking at is there have been some BIS projects that have been looking at how do you reduce the cost of FX and settlement. One of them, the 2 key ones are mainly Project Demba and Project Mbridge, who launch a multi-CBDC platform with exactly the same objective. Then the third one is actually what if we would create our own stablecoin backed by a basket of currency? And the fourth one is what about enhancing existing mechanisms, such as if we make correspondent banking network more inclusive, or if we introduce central security deposit in some country which don't have CSD today and therefore cannot have repo mechanism, which by nature influence how liquid the currency are. So the concept right now is out of the 4 solutions that I just mentioned, I'm asking the audience, which one do you think is the one we should really explore? And then the panel will do the same. And for 3 minutes, they will pitch which one they think is the one we should spend a year to look at. Is it clearer now? Okay, great. Thank you for your question. Hopefully, now it's clear for everybody. So I'm going to re-ask the question then. Who thinks that utilizing stablecoin will solve this issue? Wow, no one. Okay. Okay.
2.
Since you're the only one, you have to make a comment on this.
Oh, you were just voting.
I think it's a reflection of using a 3-currency settlement model rather than a 2-currency settlement model, which is where the efficiencies lie. It's agreeing that the third currency isn't the US dollar, is also, at least at the present time, a possible efficiency as well, or any other reserve currency. So this is a question of, could a stable coin stand in as the third currency for that? And for that, I would say, yes, that's a possible cost reducer.
Thank you. Okay, so let's move to the second solution, advancing a BIS project. Who think it's a solution to basically reduce the cost of FX and settlement? Yeah. BIS, of course. Okay, third one, exploring the feasibility of creating a stablecoin. Okay, one.
Everyone's going for the
two,
fourth.
two, yeah. Okay, so, okay, three after, only after looking at one. And so I'm guessing that for all the other people, it's about enhancing existing FX and settlement mechanism. Okay, so let's see. So I guess like now I'm going to turn to each one of you and ask you like, to pick one of the solution and do your pitch for 3 minutes. And then we will revote again. So who wants to go first?
Okay, I can go first. And first of all, let me say that I think all the four are not mutually exclusive. So it doesn't mean do one and not the other. They can go in parallel. But if we are looking at reducing the costs of transactions coming out of foreign exchange, in the short term, I must say, I believe the solution, at least for me, would be enhancing the existing FX mechanisms that we have. And first of all, I do believe that the problems that we have, or these costs that we are talking about, are not coming from the systems or the technology. It's about the people, and that's us. And if we have the willpower and if we come together to try and, put our heads together because we have to do something, we can do it. So it's not the technologies that are a problem on the current FX challenges. So the fact that low value transactions become so costly and discourage the very constituents that we are trying to serve from using the system means that we need to think more on how we can unlock value for them. And perhaps I'm a bit, maybe I've got a bit of an advantage over my fellow panelists because this is what we are working on now. And if I look at the people we are trying to serve today, there was an issue that came this morning about financial literacy, which is a major problem that we have amongst the people that we are trying to serve. Now, introducing even more complex initiatives for them, when we still have a population that's lagging behind, why don't we first try and perfect what we have? We do have cases where such exchanges are working, and one of them is going to be the DRPP, for example. Once we have done our commercial launch, we will prove that we can find a working solution while we try and find new ways of doing things. So within the current setup, what is it that we can do? And one of them, like we explained this morning, is to work on local currencies, work with local currencies. We will still use the exchange, the foreign exchange provider, but that does not directly link with the system user. So the system user does not actually know what happens behind the scenes. All they see is efficiency. And if we are able to then bring down the cost, for me, I will advocate for enhancing the current system that we have. Now, it will remove the bottlenecks and it will ensure that we can onboard more people on that same kind of platform and those kinds of rails. Now, secondly, like I said, these approaches already working in some markets. And without going into specifics of the various initiatives that are there within the continent, we do know that we have systems like within the East African community, which is IPS, which uses local currency. It of course brings its own complications where exporters, importers, there's an imbalance, or even in terms of the remittances, and you're then left holding too much of the local currency of the other country, just because you do not want to then use foreign exchange or the US dollar or the euro to do these transactions. But it is a workable solution. Now, lastly, I also believe that the problems we have with the current arrangements are not structural. So they are solvable. It's not to say this actually cannot work structurally. It can work. but it's about the willpower. It's about sovereignty as countries, where we say we will not do this because we do not want to compromise on our sovereignty, or we do not want to give too much. And even when we look at some of the initiatives that COMESA itself has in terms of meeting standards amongst its member states, it all boils down to saying, what can we do with what we have to form a region that is integrated? And the reason that we are not fully integrated today is because each jurisdiction, each member state, each central bank, each financial institution is looking at protecting themselves. So protectionism also becomes a challenge. But like I said, because these are not structural problems, these are problems that have solutions, and it's about the willpower to solve these problems. So I will say that I propose we enhance the mechanisms that we have already. And then in these forums, and as we fellow change makers, we can then in parallel work with other initiatives that will take time. Also, just to mention that regulatory frameworks are a big issue for us because each jurisdiction has its own regulations. When it comes to cross-border, the regulatory frameworks get even more complex. So if we can work on those, because those are the bottlenecks that exist today, and make these multi-currency exchanges very costly, it is possible. Bringing in more, they might actually not be complex, but once we start talking about stable coins, and I'm not saying we cannot do it, things like CBDCs, I must even say we had considered doing a study to check on the gaps in regulatory frameworks for CBDCs, and central banks, some of them then felt it was not a priority. So going to talk about stable coins at this time, CBDCs and other initiatives may not get much traction when we already have a system that already is working and can be enhanced if we have the willpower to do it. So I will stop there, Julie.
Thank you so much. Very compelling pitch. Who want to go after this?
I would agree that enhancing the existing financial and FX systems and mechanisms is probably the easier way to get there. I've done a lot of CBDC and other diagnostics for countries looking to start CBDCs, and it's an entire ecosystem that you have to put in place. It's a new ecosystem. It's having like a third or fourth ecosystem payment or money type in a country. So there's a lot of things that it can shake loose, but it just is a legal instrument. I'm a lawyer. I see these things as legal instruments, and it's no different to digital. I mean, in fact, central banks have been running CBDC since about 1970 because they digitalized their ledgers. So it's nothing new. It's got new enhanced abilities, which are really great, and I think that they can transform things, but it's a new ecosystem that needs to be put in place. If you look at the existing ecosystems, and we were forced to look at this, you really get the payment systems that you deserve, and it all comes from what your vision of success is. So what we saw is that with the EAC, their vision of success was a sustainable, integral, and inclusive payment system. So as you deepen that vision and broaden that vision, it gets on a continuum from simple to complicated to complex. Once it hits complex, you can't solve it. A mentor of mine is a math professor, and he says, complex is you can't solve. Complicated means that you've got a complicated solution. There's no such thing as a simple solution to a complicated problem. It means that you haven't defined the problem properly. It means that you haven't simplified the problem properly. A complicated problem that is really complicated takes a complicated solution. So that took us down this path of looking to see how things are currently implemented. And there basically hasn't been that much change in 200 years. And so we're trying to fit a 200-year-old model into a modern digitalized system. And we looked at that, and we looked at what the costs were. And a lot of the costs are in liquidity and building up stocks of liquidity of different kinds of instruments. And as a lawyer, that's very odd. because these are just legal instruments. You shouldn't have to build stocks of liquidity. You can transform these things, and that's what we looked at. What is the ability of central banks to transform? It's called seigniorage. They're taking securities and they transform it into currency, and they can either retire it or they can redeem currency. So central banks have got a very, very key role. And so we started looking at this way of not processing every single transaction in its own right as a foreign exchange transaction. This is something that was designed to pay for the cargo of a ship. It's not something designed for a micro transaction between mobile money wallets. And the more we try and force fit it, it's not going to work. So we looked at a whole lot. We had to do a proof of concept because of the EAC to make sure that what we were putting on the table, was viable. And we looked at this concept of a unit of account where we don't swap widgets, we don't swap foreign exchange, we swap value and we swap securities. So having a centralized security means that you can swap out any currency to any other currency. And it is particularly useful when you've got volatile and illiquid currencies. And you can contain the risk. And we looked at doing that. And there's a whole lot of other issues in and around that, particularly on choice and on price discovery. So we looked at what is the implications of having a bulk foreign exchange instrument to cover the net settlement, not the entire settlement, just the net position between countries. And this is actually very viable. So it really plays into this vision of an inclusive payment system, because we can reduce the rate to where we can process microtransactions, $5 and below, theoretically, across different foreign exchanges. And the reason we can do that is because we are only securitizing the net position. And so it's about leveraging what you've got. What can we use? We can use central banks' power of seigniorage. We can use some of the central banks have got their own CSDs. They've all got securities except one. I asked what kind of securities. They've got US securities. That's fantastic. Where's it sitting? No, it's sitting in a strong container in the bottom of the central bank, and it's actually notes. So there's no way I can utilize that. But everything else, if it's a valid security and I can trade it, we can use it. We can use it to securitize it, and then we can use to process the settlement. Currencies don't necessarily have to change hands. The value needs to change hands. And so that was the unit of account concept. And just long story short, the question came from our World Bank colleagues is like, where has this been used before? And we found ample evidence in the archives of the National Bank of Belgium. This is the prototype of what happened to become the euro. This is how countries before the Eurozone interacted to conserve US dollar securities in order to limit their they had very, very limited currency at that time. And in order to safeguard that to things that they needed to buy outside of the Eurozone, they had a unit of account in amongst each other, and it worked for decades. So yeah, it does work, and it's an IFRS standard. It's just that it's no longer applied. And I think in our current day, and particularly with like Mojo Loop, it's got all the pieces in place there that can really manage this. So yeah, existing but enhanced.
Thank you, Barry. Mike?
Okay, where do I begin? So I think I loved what Barry said earlier about transparency, and FX hides a multitude of sins. So I think there are two things that I think we need to solve if we're going to kind of bring down the cost of foreign exchange. One is the transparency element. I think that's important, very important. And I think the second one is that risk element that I spoke about at the beginning. And I think one of the reasons why I say that risk is because in a bank, in anyone who's managing these things, you're going to have a middle office that's managing exposure limits, credit limits, and so on, right? So at the end of the day, we have to respect those risk managers who sit there, and of course they're regulators that are, of course, making sure that risk managers maintain their risk adequately, because at the end of the day, financial stability matters. And so I think we really need to think hard about how we do that and make it more efficient, including for the risk managers who are going to put constraints on FX and bump up the charges, particularly when there's illiquid currencies, because I think Barry also touched on the fact that liquidity is scarce, and we have to think about how those solutions work. Now we know that for the highly liquid currencies, again, there are solutions in place. We have CLS in place, which takes care of netting, effectively making efficient use of the liquidity that is there. But we don't currently have an opportunity for that to apply to the liquid currencies for a number of reasons, right? So maybe that's where we need to think about going. So solve the cost of risk. I was lucky enough to be involved in a number of BIS Innovation Hub projects, but not the ones you mentioned. And I think maybe we should look more carefully at them. The two I'm referring to are Project Mariana, which looked at using alternative methods from the decentralized finance world, and particularly the concept of automated market makers, a different way to price FX and to encourage people to place liquidity into deep pools that would then automatically enable foreign exchange at a very efficient rate, somewhat overcoming some of the challenges that we have if you're asking a bank or a kind of a desk inside a global markets trading floor to price these things. So you change the mechanism completely, potentially using automated market makers and changing the balance. And instead of it becoming about the FX cost alone, you actually reward people for placing deposits into the pools, which are then used to automate pricing. So I think that's something that's really interesting to look at. They had this concept of a transnational network where central banks and, well, on behalf of the commercial banks, would help place tokens into a shared network that can then be used by the automated market makers to transact. It has a lot of potential. It's working in the DeFi world. It definitely should be looked at. In fact, it is being looked at because there's another project called Project Rialto, which is running at the moment, linked in with Project Nexus and many others, that's looking at solving some of the challenges of correspondent banking, which doesn't always have to be the model that's used, and putting in place a different mechanism. So Rialto, I think, is definitely one to look at, looking at how we can think about FX efficiency, bring that concept of the automated market makers or alternatives as well to market in a way that can be used at scale. And I think the particular use case, again, is for the currencies that don't enjoy the ability to be part of the CLS system and can address the transparency issue, because it all becomes kind of driven by a model that's very clear for everyone to see, and should reduce the cost, should help address some of the efficiency of liquidity usage in those markets. So for me, it's number two. Probably look more carefully at the BIS projects, just not the ones you mentioned. And I really like Jadida's point. It's not one or the other. It's actually a combination of all of them. And I think actually by looking at two, we're really doing four as well, because it's looking at ways to improve the mechanisms that we already have, because we're going to have multiple mechanisms that will work side by side with each other, depending on the cost of liquidity or depending on how the market is positioned or how liquid or illiquid it is. So it's a combination of those things. We've got to pick the right tool for the right scale, I guess.
Thank you. Well, thank you. The three of us, like Jadida, Barry, and Mike, like for pitching for effectively the same solution. So we are not going to re-vote again, because obviously there was already consensus around solution 4. But I'd like to add sort of a few points and perhaps a few challenging questions for you. First one is, Barry, you mentioned that it's an exchange of value. Effectively, it's not an exchange of basically the currency and how do we build liquidity. Completely agree, to be fair. And one of the things we've been also looking at on the side is a bit, how do you tokenize commercial deposit to effectively build this liquidity? And to be fair, one of the challenges that you have today with the existing network is how do you get some of this liquidity? And this is a bit my challenging question for the three of us, right? For the three of you, is if you look at CLS have been live for a long time. And yet it's only including like, what is it, 15 or 18 currency? 18 currencies.
18 stable currencies.
Exactly. So why now? Why would CLS extend to other currency, right? And same for enhancing correspondent banking network. I think Barry mentioned that basically it's a 2 decades issue. SWIFT has been live for 50 years, right? If I recall correctly. So again, what is the thing that will move us over the edge now? And I guess one of the other thing as well is what you mentioned, Project Mariana, Project Rialto. To be fair, I didn't mention it, but that's also 2 projects we are considering too. Now, when you look at Project Mariana, and we have Mika from BIS, so please feel free to correct me, and Mike, you mentioned it to some extent, that it was the central bank basically providing the liquidity pool. And one of the conclusions of the report was that there was sort of no commercial viable model for the central bank to park their liquidity in the pool. I think for me, that's one of the challenges we will need to look at if we consider Project Mariana more deeply. Second challenge is, again, if I recall correctly, of the currencies looked at by Project Mariana, these are extremely liquid currency. There is no shortage of USD in this world, of SGD in this world as well, right? I mean, when we look at effectively getting some dollar out of Malawi and Kwacha, and Michael and I were privileged enough to basically talk to some stablecoin provider, and they were telling us the number of trades that cannot be executed because nobody wants to buy Malawi and Kwacha overall, right? So I think that's also something we should consider is, yes, AMM is working in very liquid currency, but would that work in illiquid currency? And to your point around the DeFi world, these are not regulated, or these are effectively environments that are not as regulated as effectively the financial services. And you mentioned risk. This is where the risk is often ignored, not price.
Can I
yeah,
comment?
sure.
I think my point is actually, I think it shouldn't be focused at the highly liquid currencies. My point is we should consider looking again at potentially Mariana with the view of illiquid currencies. That would be something really interesting to look at. And I think if I remember correctly from Mariana, it was actually it was central bank money, but put into the transnational pool on behalf of commercial banks. So it was commercial banks who were pledging liquidity to the pool and being rewarded. So in other words, they effectively earned interest or they earned tokens for pledging. So it wasn't the central bank taking the risk. It was the commercial banks, but it caused liquidity fragmentation potentially, which is a different problem. Yeah, we're not going to talk about that today.
Thank you. And yeah.
Sorry, I just wanted to make a couple of points on that. I've lost count. I don't know about the rest of you. I've lost count of the number of systems developers who say, well, I tell you what, if we solve the easy problem first, then it'd be easier to solve the difficult problem. It's not. We're here to solve the difficult problem. There are no problems associated with currency conversion. As everybody says, between dollars and euros, there's plenty of liquidity, all of that kind of thing. That's why we need innovation, because people keep trying to generalize the simple solution to the complex problem, and it doesn't work. I also want to make a point about Mariana. One of the difficulties, I think, of the problems that we have to face is that there is a fixed amount of liquidity, generally speaking, and even pooling it doesn't make it bigger. Now, one of the drawbacks of the Mariana thing, if I've understood it correctly, was that essentially there was an elastic rate And the less liquidity there was, the higher the rate went. It was designed to make sure that you would never run out of liquidity. But in the real world, you do run out of liquidity. And that's the problem that we've got to solve. I mean, that's the thing that I worry about, Mariana, is easy algorithm for determining the exchange rate, and then everything will be fine, which in highly liquid currencies, it is.
Fair point.
Thank you. We are running out of time. I think yeah. Please.
It really builds on Michael's point, and that is in the post-Bretton Woods world, I would have said that Bretton Woods world was actually the simple case. There was a world currency. It was tied to gold. It was as good as gold. You could trade it as gold. And in 1971, that became no longer true, and the balance of payments threw the whole thing out of whack. It's the balance of payments that I'd be concerned about in picking any currency of the existing set, because it simply repeats the problem we already know that we've experienced. However, if you have a purpose-built or purpose-designated stablecoin or other type of third currency, is that not worth exploring, whether you can actually tackle the problem that way and say its only purpose is to manage this, it's fixed, but relatively large pool. If that's the only thing it serves for, and that you're not actually using it in retail and you're not actually using it to securitize anything else, does that actually alleviate some of the problem? Maybe it doesn't. I have exactly 0 days on a treasury desk, so thank you for humoring my comment. But
unfortunately, we run out of time. So thank you very much, Jedida, Barry, and Mike, and thank you as well for the comment from the audience. Obviously, we're going to be around for the next 3 days. So if you feel you have a key contribution to make on this topic, please do. If you want to get involved in one of the work stream, please do as well. As Barry mentioned, this is a very long-lasting problem that we are trying to solve. So the more experts we have to look at this, the better. So really, really, please feel free to reach out to join one of the work streams. Thank you.